Hi, this is Keith Schneider, CEO of MarketGauge.com, and this is May 21st, 2017 edition of Market Outlook. So, quite an interesting week, massive sell-off as a result of the controversy on Capitol Hill. So let's get into the details. What is interesting is that you would think that the volume indications would be pretty strongly negative with the fairly large sell-off, but that is not the case. As we can see here, that we don't have 4 or 5 days of accumulation or distribution. Now, we did weaken a bit in the Russell, and as we have actually traded down and underneath our 50-day moving average, it's not surprising to see weakness in the IWM in volume as well. But net, you had the distribution day on the big down day, really big volume, and then on the two up days, which was the recovery, you also had some pretty decent volume. So overall, pretty neutral in terms of our volume readings, but our bias is still a positive because our last signal was an uptick in the volume readings. Now, in terms of the overall change, you can see on a weekly basis, we were down, modestly, on average about 0.5% on the week, with, of course, NASDAQ 100 down 0.5, and actually the S&Ps made a valiant attempt at recovery. We did not fill the gap in its entirety, but net, we only ended up down for the week 0.26%. So much ado about nothing in terms of the net overall down move. However, we are sitting with a gap in the indices, and it looks like potential sideways and distribution action as well. So net, we're going to get into the charts in a moment, but on this particular page, looking at volume, we're still, as you can see, in an overall positive scenario for the moment. Okay, let's take a look at sectors, because this one is a lot more telling in a sense. So when you take a look at the sectors, the problem is that what shouldn't be leading is. And so take a look at XLU. XLU was up 0.7% for the week, as opposed to the S&P, which was down 0.3%. And in fact, really aside from semiconductors, which has been really on fire, and that's a good sign, the net result is in every time frame, 5-day, the 3-month, right? You can see that the utilities are up 6.2%, with the S&P only up 1.5%. Over the last 6 months, the S&P's up just about 10%, utilities up 12.7%. And year to date, utilities, as you can see, 7.2 versus 6.6. So utilities outperforming the S&P 500 is a risk-off indicator. The other thing that's of concern is look at all these indices or these sectors that are showing either warning or bearish. So that has been a significant downgrade in terms of sector performance. So net, we're showing risk off. The positive sign, of course, is that technology and semiconductors still overall holding up extremely well. So you got this tug of war, but for right now, we're looking at this as a downgrade and a minus because of the amount of sectors that are in warning phases as opposed to bullish, and the fact that utilities are outperforming the S&P 500. So risk off, is what the overall picture is showing in terms of sector performance. Now, let's take a look at market hotspots. And the big driver here is what we've been pointing out for quite some time that actually now has accelerated to the upside. So we have a situation, right, where we know that we were down about 0.5% on average in U.S. indices, but take a look at what's driving the rest of the world, and it's Italy, Austria, Spain. France is not on here, but it would show up as well if you relax the criteria. So as you can see, what's happening here is the foreign stocks, especially Eurozone, is showing extreme strength, right? Up over the last 6 months, 28%, over the last 3 months, in the 20% range, and that is certainly outperforming the S&P 500, which we just showed is at 1.5%. So considering the political forces at play, it seems like the centrist Macron victory is definitely playing out in a positive way for Europe, and the populist vote here for Trump not playing out nearly as well. And that could be a theme that continues for quite some time. All right, so now let's take a look at some of the market internals. Okay, so as you can see, this week, with the weakening in prices, you sort of got some sideways action in advanced decline, but we're under our midpoint. So on this particular thing, on this particular part of it, I'm giving it a minus, right? You got a similar situation right now, right, in terms of the McClellan oscillator, which is really a longer term version of this bottom one. We're looking at 2 sets of moving averages of the advanced declines. And you can see you really didn't get all that much strength. We'd love to see it get overbought where the corrections are narrow, especially as you're moving above the 200-day moving average. But, right, as you can see, even on this new high up here, right, meager results in terms of the move to the outer extremes. And that's sort of still in play here. So in terms of up-down volume, a little bit better. And so on a shorter term basis, you're sort of looking at a neutral to, I would say, negative overall. McClellan oscillator, definitely more on the defensive side. So market internal strength on the S&P, even on the heels of this rally, back above the 50-day moving average. Still, the market internals are showing it's running out of steam. So it'll be interesting to see what happens here next week. Do we actually fill the gap, attack the highs, or actually roll over and then fail at our 50-day moving average? And I'm keeping a close eye and extreme flexibility here because anything goes, as you can see, waning strength in the market internals, sort of this compression zone, that failure at the highs makes this rally certainly suspect. But listen, the longer term trend certainly intact. Now, the fact that we're losing relative to the European markets is also noteworthy because that is a significant change that could persist for some time. So as we go potentially sideways, the other European stocks could continue on its trajectory north. All right, so now let's take a look at our next chart here on market internals. And here's the composite. This is the NASDAQ composite index. And this is actually looking a bit better overall, although you still have the gap and this failure at the 10-day moving average, and we closed pretty weak. So I would really like to see this market gain back over the 10-day moving average. In terms of volume, you definitely got to cross above the midpoint, a little bit more positive. And again, NASDAQ in a much stronger position. You can see we got overbought, which is good, net. So our corrections should be shallower. However, you can see advanced declines on a 10-day basis, still beneath our midpoint down in here, and that is a net negative. Same thing for the McClellan, which looks out over the next 30 days or so, and that still has not been able to get above the midpoint. So right now we're looking at the market internals here on the NASDAQ as a small negative. Okay? Now, let's take a look at some sentiment indicators, and that's let's take a look at new highs, new lows. This is very strange what just occurred here. Okay, hang on. Okay, so in the terms of new highs, new lows over the last couple days, even with the 2-day rally, you can see we're losing steam, and we broke down through our 70% level, and that is an important breach, right? First, we started to fail in here, right beneath the 85 after getting well overbought, and this is definitely a cautionary warning flag here. This is a negative on the this other market internals reading, which is 52-week highs versus lows. And you can see you certainly have sort of this downward trend forming and accelerating trend to the downside on the amount of new 52-week lows. So that's definitely worth noting. Okay, let's take a look at NASDAQ. You've got a very similar scenario in NASDAQ as well. So breadth getting narrower across the board, right? You can see you got this trend line here, and this coincides with this now turn beneath the 70 level. So another sell signal. So in terms of market internals, you're definitely seeing some additional weakness. With the exception of volume, those other readings, advanced declines, up-down volume, definitely suspect on this move over the last couple of weeks. Okay, now let's take a look at some sentiment indicators, and we'll wrap it up. First of all, we had sort of a 6 to 8 hour wonder trade where volatility really popped, and if you were quick, you could have made a quick 10%, 15% move in volatility. As you can see, we jumped outside the Bollinger Band within a couple of hours. We had this massive move. It continued on an intraday basis, and essentially the next morning was the lower opening after this initial down move, and that was your cover point, and that was it. So this is pretty classic. You can see something similar happened here, right, where the market had this sell-off. You had this pop through the 50-day and the 200-day moving average in the VIX indicator. That was your signal that you could have actually bought VIX. These are good for short-term trades. You got a nice little pop before the reversal down. Similar scenario here, but it does appear overall that this swing from high volatility or a spike in volatility all the way back down is a pattern that might continue for the foreseeable future. So yes, we did get a pretty good sized drop, but let's be poised to watch this for another pop back up. One of the things to do is watch for a cross back over the 5-day moving average. So one of the things that we do is we take a very short-term moving average. Trading this VIX is a short-term type play to take advantage of these pops overall. Certainly, I would definitely be playing short-term pops against the main trend, which is still overall bullish. And as you can see, this is our 200-day here. The 50 is here. Our 10 is here. We still closed beneath the 10, but rejected the test of the 50 and moved nicely above it. So for right now, the S&P 500 still intact on a bullish trend, although with the short-term pattern, with the gap, is and under the 10-day, is definitely making this suspect. So wouldn't be surprised to see potentially, certainly another test of the 50, but we're going to let the short-term market patterns tell us how to move forward. And in that case, being a student of the opening range theory and understanding the pivot strategy is definitely in order, right? So we put those two together, and that helps determine our short-term trading. If you have any more questions about that, please feel free to contact us at marketgauge.com, where we do have additional information and courses if you're interested in it. Okay, let's take a look at our last indicator here, and that's looking at the ratio of short-term 1 month versus 3 month. So one of the things you can note is that we definitely got pretty good wrung out here. We sort of tested what I would call the first level of oversold and started to bounce. So net, I'm looking at the volatility reading as more of a flush and somewhat of a positive as we're starting to bounce off of an oversold reading. So I give that more of a plus than a negative. So as you can see, we've got some concerns. We have an unfilled gap, nice sideways action. We can certainly see a trade back down to the 232 level. Or on the other hand, if we can fill the gap and power out, this might have been a flush of weak holders that we needed for a more sustained move to the upside. But we're going to let the market patterns determine which way. And remember, in this type of environment, that it's really important to understand that the geopolitical environment trumps the overall economics, which right now, our leading economic indicators, extremely positive, unemployment, excellent. Of course, always the biggest concern is that they start to deteriorate, which when markets really tank is when you get into these recessionary and contraction modes, and that fundamentally is not in play. However, what is in play is pure psychology and fear and greed. And as you can see, markets can really get hit despite underlying good fundamentals. All right, that's it for now. See you next week, and stay on top of the short-term development.